Investors, welcome back to Everything ETFs. In this video, we're going to be breaking down SCHD, talking about this fund and if we hold it. As usual, I'm one of your co-hosts, Spencer Invest, and I'm going to throw it to our other co-host, Brad.
Brad from Income Architect. How's everybody doing today?
Hopefully everybody is doing good, even in these rocky markets. Everything seems to be going a little bit crazy. I know there's some investor sentiment out there is getting a little sketchy, I would say, but we're here for the long run, not the short term. So we'll make do with what we can.
Time in the market always beats better than timing the market.
That is such an important quote. And I used to say it all the time, but I feel like for new investors, it's really key. You have to have time in the market. Definitely. And I think that's something that people think. Warren Buffett, for instance, phenomenal investor, right? But I don't think he specifically is outstanding at picking stocks. I don't think he's bad by any means with his value investing style. He's just been trading for what, 60 years or something like that? 70?
He made most of his money after 65.
Which is crazy because he had so much money that compounding just absolutely boomed.
That's right. And I think when we talk about SCHD today, it's the compounding effect. It just takes forever to get there.
It takes forever. Okay, so we'll pull up the SCHD website. And I'm curious, Brad, on just your take on SCHD. Is this a fund that you would consider owning, have owned, or would never consider owning?
I have owned it in the past, more when I was trying to dividend invest. And then I realized dividend investing doesn't get me to where I want to be fast enough.
Yeah.
I mean, there's a lot of ways of doing it, a lot of ways that you can skin a cat. And hey, if you're an older person, let's face it, if you're 70 or late 60s and you want something defensive, then
Hmm.
maybe SCHD is something for you because you're not trying to beat the market. You're just trying to outpace inflation.
And we can discuss pros and cons with this too, but I also want to pull this up on like a reinvestment calculator, and I'll do that
Yeah, I mean
because
that's what the whole conversation about this is. Yeah,
yes,
you can put money in and it pays you what, the 3.4, 3.6%
yeah,
compounded quarterly. And then what people do is they look at it going, okay, if I put $20,000 in, compounded annual growth rate is X, and I'll be getting 11% because it's compounded on myself on my original investment. And I just
hmm,
kind of throw my hands up going, I'll take a synthetic dividend from, pretty much anybody else, GPIX, by eye. I mean,
hmm,
you can list the synthetic dividends and it will, you know, outpace these in the distribution. But in a down market or where markets are a little unsteady, SCHD, because of how it's made up, will actually do better in a downturn. I mean, if you look at it right
hmm,
now, it's skyrocketing.
yeah,
It's investing in the sectors everybody's rotating to. So here we've been beating it down for the last 3 years, and then all of a sudden it's up like, skyrockets.
yep.
So you just got to sit back going, it depends on where you are in your life. And are you looking for something that's more defensive? Yeah, I am. I think we were talking about buying Bitcoin earlier. So,
we we definitely were. We are not the target audience for SCHD,
yeah, that's good.
and
That's good. Okay. Bitcoin people on this side, SCHD people on this side. Two,
yeah.
two different crowds.
And it's funny, Brad. We're gonna get comments on this video already. I can already tell because whenever I make a video on SCHD, now that it's doing well, I made a video 2 months ago. No one really batted an eye. It was a good video, and now I
Yeah.
made a video like, "Oh, SCHD is booming. Here's why." And I got "You're just a YouTube hype guy. You don't like this fun, blah blah blah. Why are you're only talking about it because everybody's talking about it right now?" And I was like, no one commented that when I made the first video. Like, it's just because of the fact that it is doing
Hey,
well. But that's
Yeah,
also
more
a reason to talk about it. That's why we need to discuss what has shifted and why money is flowing into these funds, which it always cracks me up. But I am not invested in SCHD. I have been in the past, but like yourself, it's just I need a little more risk than that. I need a little more return. And I will say, in that video I made a couple months ago, I made it. I might have flipped the market on SCHD. Maybe my video was the motivation for people to go out and buy it because almost immediately, about a week after that, it started to trend upwards. But
yeah. So
before that, it wasn't even it wasn't even underperforming. It was significantly underperforming. I mean, the market was up 16%. I mean, the S&P 16% and SCHD was negative. I mean, not including the distributions, but even with the distributions, it was in the red. And everyone was like, "Oh, it'll bounce back," and it is bouncing now, which is great for SCHD holders. If there is a fund that I'd like to see run that I don't hold, it is SCHD because it's a good. I would say they're a pretty good audience. It's people that are lower risk that are probably trying to live off of this, if not, now then one day. But it's just not for me. I just when you have SPY I, when you have QQQI, even with the risks, even with the ups and downs, even this might be crazy. BTCI, the yield you're getting on BTCI, even with Bitcoin pulling back 40% plus, it's still just more intriguing to me than a fund like SCHD.
yeah, I think when we talked earlier about BTCI, hey, it pulled back 40%. Yeah. For me not to get my 8% on my original cost, huh, it's got to go down another 31%,
Oh, which is insane.
which is an
That's
insane number,
crazy.
right? But
Yeah.
could it happen? Sure. Can I average down between now and then?
Mhm.
Plenty of time to be averaging down. I just got paid from BTCI. So
Mhm.
maybe I'd buy 2 or 3 shares here and there and average myself down and still collect the higher distributions. I just think it's put it like this: if BTCI goes to zero tomorrow, it doesn't ruin my retirement.
Mhm.
And so don't go out and invest in anything that you're not willing to lose 100% of that investment.
Oh, yes. And that's a very key point. You have to understand this stuff. No more following just the hype. I love seeing one thing I will say about this downturn that we've seen, especially with like software and whatnot, all these YouTube, and I see it more on TikTok than I do on YouTube, these hype guys that are talking about a fund that they believe will quadruple for literally no reason other than the fact that they have money invested in it. Those people tend to get really burned during these market downturns. So there is, a silver lining, but
Silver, talk about silver there, right?
silver.
Yeah, and that's a good one because my first silver video was 8 months ago.
Hmm.
It was at $30 an ounce. I mean, I just bought the new copper fund from Curve,
Curve. Yeah.
and it's one of those. The whole play on copper is not this year, not next year, not the following year, but
Hmm.
5 years down the road.
Interesting.
So, right now it's like, hey, they make enough copper for the demand right now.
Hmm.
It's a 5-year forecast that it starts to become looking like silver. So I got, again, I got in early enough that maybe I do well, maybe I don't do well. Hey, I still collect my percentage, and I can tell you
Hmm.
it's going to pay out something close to their gold fund.
Hmm.
He told me the IV was the same as gold. Okay.
Interesting. I would have thought it
Yeah.
would be a little higher.
I would have thought so too, but
Yeah.
copper IV was lower. It was the copper miners that were
Oh.
higher that gave
Hmm.
them the higher IV.
Yep.
And I looked at his copper miners. The copper miners are up like 120% over the last year. So
Yep.
you sit back and go, that's why I like it. But let's get back to SCHG. I think there's other plays, but it gets back into if you're looking at your Sharp ratio and your other ratios, how does this fit into somebody's portfolio? Is it a
Hmm.
defensive play? Does it have a high Sharp ratio? I mean, I came up with a couple funds that have significantly higher Sharp ratios than this.
Yep.
So you sit back and go, maybe this fits into somebody's portfolio. Maybe it doesn't fit into somebody's portfolio. I mean, wasn't Yield Max supposed to come out with a double dividend fund for
Oh.
SCHD? It
Yeah.
was it. Where's that? I mean, don't know if I would invest in it, but hey, there was supposed to be a double dividend fund on, and I look at that going, and it's very feasible, right?
Mhm.
Because if you look at the long short fund from Neos,
Yeah.
they're selling those puts, and you just sit back and going, okay, they're selling those puts just like they do for Cashy, and they're generating about 5% yield
Yeah.
on selling those puts. Has nothing to do with the underlying. They're just selling puts 2 weeks out.
Mhm.
So they can easily generate 4%. And
Mhm.
that's why I sit back and going, I think that everybody talks about the 4% and living on 4%. And it's just like, hey, if Neos can sell calls or puts and generate 4% on underlyings, then I think the 4% rules is just broken. Right. I mean,
Exactly.
it's just broken. Because there's other funds out there that the underlying is paying about 4%, and they're literally doubling it
Mhm.
by selling puts, making it an 8% yield. And
Yeah.
you're sitting back going, it's totally feasible, totally possible to do something like this. So
Mhm.
you sit back and go, is it something that I invest in? I think SCHD, if the distributions are a little bit higher, could be a good
Mhm.
defensive play.
I agree, and I think well, actually, now that we're here, we have to remind everybody, if you guys are watching this, to subscribe to Everything ETFs because we are almost to 1,000 subscribers. And again, we are super grateful for you guys. Last episode, we gained like 150 subscribers, Brad. People were happy with that one. So we're going to keep putting out more content. And we'd love some ideas from you guys on what you'd like to see us talk about, review, rank, all sorts of things. So, the little early on plug for Everything ETFs. But I also want to discuss I think SCHD would be so much more popular if they converted to monthly payouts. But the question is could they do that viably with the structure of the fund? Because I'm guessing most of the holdings, like we haven't pulled up here, they're just paying these out based on when the holdings pay out, and they're are they buying them specifically to try to maintain the distribution? You think, or is it just
No,
random?
most of the underlines are quarterly payers,
Yeah,
so they just pile it up and give you what they're
send it
paying.
out. Because if they found a way to make it monthly, people would really
Yeah,
enjoy it.
and I think you know, personally, because I had a job, in the corporate world, I got paid monthly. I was a monthly employee.
Mhm.
Everybody needs a weekly, and I'm like, what are you working out? McDonald's? Sorry, sorry, nothing wrong with McDonald's people, right? Right? But but I got paid on a monthly because they sent me a high, I don't know, high something pay, right? They had a name for it. But I
Yep.
got paid monthly, and it's just like I think scheduling yourself at least on a monthly, because I think I told you or said someplace along the line, I started taking some 72 Ts, and you can't take those weekly. So,
Yeah.
that's not how it works. Right.
Yeah.
So, a monthly is the earliest frequency that you can do with it. So you sit
Mhm.
back and go, it's different for everybody. But I agree. SCHD, quarterly payer. But I do have some business development companies that pay me quarterly, and I just pile it in and say, oh, this month I'm making an extra $1,000.
Mhm. Yeah. Nothing
So,
wrong with that. There you go.
what are the top holdings of SCHD?
Let's see. Lockheed Martin, Chevron, Verizon, ConocoPhillips, Texas Instruments, uh, Merck and Co. American Co.
Yeah, pharmaceutical.
Okay. I need to know more about these pharmaceutical companies. Bristol Myers, Altria Group, Coca Cola, and Pepsi.
Okay, so there's a bunch of good names in there. I mean, Lockheed
Popular names.
Martin's, Lockheed Martin being defense,
Yeah.
all right? So that's probably going to do well, right? Then, you got some pharmaceuticals in there. That makes sense,
Mhm.
right? So, yeah, I can see that doing well under the conditions that we're currently in.
Yeah.
It's not technology stocks. It's not the
No, it's
Nvidias
not.
and the rest of them, right?
Yeah.
So yeah,
Yeah, it is, it's interesting. Let's throw this on a calculator here. Let me pull this up. And I'm curious, let's see. I think I have everything plugged in close to correct, but I want your take, Brad. I These dividend calculators, of course, we have to have 1,000 ads pop up. Do you do you ever run these calculations yourself?
why?
I'm just curious because if you have like I have a 30-year timetable in right now. Let me zoom in.
I
But you
won't
would
live.
need
Listen, I won't be alive in 30 years. Okay.
what do you want me to
Just
put? Don't say that, Brad.
I guess technically my mom's made it that long, so yeah, I
See?
can make 30 years, right?
There you go.
I just know the timetable said my average life expectancy for my age right now is like 27 years, and it's just like, well, I better get up every morning.
We'll be pretty close. We'll get
Yeah,
there. But I'm
yeah.
curious
So
because the if you did the expected annual dividend increases, I guess I can just look at this, what the SCHD like CAGR is. Um,
that's compound annual growth rate, by the way.
yeah, so
It is pronounced KGAR.
CAGR. Oh, I always say
Yeah,
CAGR, KAGR. Maybe
KGAR.
I say
Yeah,
it wrong. That's the
KGAR.
that's the
Everybody
problem with
knows what you're
being
talking about.
YouTube educated.
That's right.
Yeah,
Oh,
so 10-year, it has 9.77% annually. So I guess we have to plug that in here for the expected dividend increase, right? And let's calculate this. 30-year period, they're having a $10,000 investment, average annual total return of 20%, and you end with 2.5 million in 30 years.
how much are you putting in monthly though?
None. Investment amount is just your $10,000. Let me zoom in a little more to where it's easier to see. So we have our investment amount here, 10,000. It gets us 317 shares at the current share price. And if you hold it for 30 years and an expected yield of 3.5%, my question though, Brad, is can these companies maintain a CAGR that high?
They'll rotate them out. It's just like the S&P 500. Come on. S&P 500 is built to go up. SPY is built to go up every single year.
Mhm.
If a company starts to not perform, it gets cut.
Interesting.
Yeah,
Yeah, because
so
the 5-year is 7 to 9%. Yeah, I guess they could. They'll just rotate them as much as possible, and that's why I guess the turnover rate. I thought the turnover rate was a little bit high. Let me find it.
yeah,
Man, they have so much info on their website. Tw
it's
28.5% turnover rate, portfolio turnover rate.
that's right. I mean, and there's other ones like Kings. Isn't there a fund like Kings out there that it's the dividend kings that they've been paying for
Mhm.
so long? They're dividend kings. I mean, I was into that type of investing for a couple years before I turned into more of the synthetic dividends.
Yeah.
And I like the companies. I mean, you know, here's, I used to write cover calls on Coca-Cola.
Yeah.
I mean, you take KO, it paid you a dividend. You could get an extra 2-3% by writing a cover call on it, and
Yeah.
it wasn't even that difficult. I mean, you just wrote it out a month out, and
Mhm.
if it got in the money, you just rolled it the next month. I mean, you just like eventually it would come back in the money, out of the money. It didn't matter if it got called away. It got called away.
Mhm.
But that was too much work for me. That's how I'd rather complain about somebody else doing it nowadays.
Yeah. Well, and part of the issue I think for a lot of investors is can you watch the performance of the S&P 500? I mean, if you back tested both of these, I'm not sure. I mean, SCHD is what, 2010 is when it was created. Let me pull it up. 2011. It would be hard for me to hold, like, let's say you only have SCHD. Can someone diamond hands SCHD that long without looking at the returns of the S&P, of the Nasdaq, of tech, and go and hold this all the way through these runs that we've been going on, right? Like over the last 5 years, everything since the pandemic plunge, really. that's my thing is I guess if you didn't watch what was going on and just held it and were okay with the uh with the
Let's face it. Everybody that watches us would have a hard time doing it,
yeah.
right? Just let's throw it out. My daughter, no clue. What is my wife? My wife checks her account once every 3 years. So at the end of the day, a lot of people can diamond hand this stuff like it's like
Without
no
even
tomorrow.
realizing, without
Yeah,
knowing what diamond hands are.
yeah. I I used the term paper hands
Yeah,
the other day. Somebody did not know what paper hands meant. So yeah, if you don't know paper hands or diamond hands, don't get offended. We're not trying to offend you,
we're not.
but there's paper hands and diamond hands, and some people are just diamond hands because life gets in the way.
Mhm,
And yeah, and I've decided personally, and this is a more of a personal aspect. I want to look at my account every other week at
mhm.
best. Last thing I want to be doing is buying and selling and trading, and that's work.
Yep.
That's right. I
It's
mean,
work. Yep,
if I wasn't on YouTube, it'd be a different thing. I mean, I wouldn't be looking at this all the time. Yeah.
yep.
Okay. So it was so bad when I was Bitcoin trading that
Oh,
I used to sleep with my phone and look at it every 30 minutes. Never got any sleep.
Brad, that is
Right.
so funny because I used to trade IPOs when I mean, what year was it even? It must have been 2022, and it was when every IPO, it didn't matter what it was, they were booming. It was all hype. We've seen a little bit more of that over the last 6 months too. I'm not
Yeah.
sure if it's still going on. I
Yeah.
used to wake up because yeah, because I'm on the West Coast, so I would wake up before all my college classes, before work. I would set an alarm for right when the market opened. I would wake up, I would look, I would sell it, and I would go back to sleep. And I was making sometimes 20 to I made like 50% on some of those. I didn't lose money on a single IPO because they were just all booming. But that's just the way that it was going. It was active trading. It felt like a job, and I really did not like it.
And for me now with technology, Google Sheets will send me an
Yes.
email when something crosses the 200-day simple moving average.
And that's absolutely amazing. I actually had it I had Gemini create this, and we can even jump into this for our next, topic of conversation, some of the competitors of SCHD. But yeah, I literally just threw all this in Google Gemini. I said, make me a Google sheet with these tickers and give me these descriptors. And there we go.
Yeah, I mean, there's a bunch of them out there, right? And if you're
Hmm.
going to get into this type of investing, the one of the biggest things that we don't talk about, and I even made a video and I posted it today, the actual cost,
Hmm.
right? What is the fund fees? And I noticed today, and I did a video today, and I noticed today that 3 funds that I picked that did the best
Hmm.
also had pretty much the lowest fees.
Really?
Yeah, I mean, you just sit back and go, there was only one other fund that had lower fees,
Hmm.
all right? But beyond that, everything else had higher fees. So you get into that ETF slop. I might redo that video and say, why is all these guys' fees so high and they don't do better than these funds?
That's the thing. It blows my mind how expensive some of these funds are now. And I'll even say it. I think maybe I shouldn't say. I might think that
Yeah,
Neos is too expensive. Now
they're
the only
they
reason go ahead.
they're up at the top. They're up.
They're
And I've asked,
yeah.
literally. It is not something. How do I say this politically correct? There is nothing I won't ask somebody.
Yep.
At least off camera.
Yeah.
Uh, yeah, yeah. Troy and I have tons of conversations, and I've asked. I said,
Mhm.
I said, how many billions do you have to get? And he goes, it comes up every annual meeting with the board of directors. So
Yeah.
the fees are set by the board of directors,
Yeah.
right? And it gets into that management fees. And, and I'm going to say, I'll throw this out about them at least, is they're still growing and they still
Mhm.
have that growth spurt. They got
Yep.
19 funds today, but how many more do they come out with? Who knows? We
Mhm.
might get in trouble because they're going to come out with an SCHD one, right? Yeah.
That would
By
be
the way,
funny.
I have no inside information of what their next fund is.
I don't either. They lock that stuff down. They are very careful with
Yes.
what they say. They're very, very careful, which you should be. I mean, again, even with the higher fees, I'm okay with the fees because I think they're one of my favorite issuers. I know that. They're one of my favorite issuers. But yeah, I was just that comparison video I did with all the Nasdaq companies and how GPIQ is just now beating QQQI.
Yeah, yeah. And I did a video today, and it's GPIX and SPY and
Yeah.
T SPY. And you take those three, they got lower fees, right? And then you put it up against the rest of them that's got 0.99. It's just like, okay, why does all these other slop funds are at
Mhm.
0.99 and these funds are at 0.68, maybe a little bit lower?
Mhm.
And you just sit back and go, these do matter. And we're talking about dividend funds now.
Yeah.
So SCHD has to be cheap. You got the Vanguard fund. They're
VYM is
known to be
so
cheap.
popular. I mean, both of these. When it comes to these style of investments, because retirees are so risk averse, which is wise. I'm not knocking that by any means. Look at the AUMs for these funds: 85 billion, 75 billion, 105 billion dollars. And then I talk about some funds that are under 100 million in AUM. So it is amazing the amount of money that are in these funds. And I guarantee a lot of this is probably what advisors holding these in comparison to what we normally would talk about. There's
Yeah.
got to be some.
And off conversation is a fund needs $34 million to be break even.
Hmm.
All right. So people ask me all the time, how about if they don't have enough money? Well, they'll close up and you get all your money back. I mean, it's a
Hmm.
really, and by the way, it only takes days. It's not like they hold your money forever, and it's in trust. But 34 million is a break even. A fund gets to 100 million, that's probably going to be around. Right. But once you get to a billion, now you're making money. Now you can start looking at, does the fees and amount of money and cost to actually operate the fund, does it take that? And how much profit margin do you need?
Hmm. Hmm. Very important. And it's funny, Brad, you reminded me, I made a video um, on a bunch of ETFs that were being removed. And it was really interesting. So it was a bunch, I mean, a bunch. I talked about how the SEC denied a bunch of funds being created that were 2x, 3x, and 5x leveraged. And it was really funny because I made this video and I showcased a couple funds. I think there were 8 from Defiance that were being removed, all part of their 2x leveraged series. They have a bullish and a bearish. And so I made a bunch of videos. I made one video and I put it up and I said, here's what's happening. They're denying from these issuers. It was like Yield Max, Granite Shares, all the different, you have Title, all these thrown in there. I put the video up. It boomed. It got 20K views in about 2 days. And I was really happy. I start getting emails from these companies and it blew my mind. I had one reach out and they were like, "Hey, so this video, we've received tons of calls today that people are worried about our funds being completely removed." And basically people had watched the first minute of the video, freaked out and not finished it to see what funds were actually being removed. And I was like, I promise I didn't make a video just, lying about stuff. It was just a problem with viewer retention and whatnot. And so it was cracking me up. And they even said, I'll just say it was Granite Shares because I talk with them all the time. And they were like, no, it's all right. That's really funny, actually. They're like, we're just telling them, no, our funds are not being removed. It's just that list of the ones from Defiance. And I was like, yeah. So, but it's so interesting. With these higher risk things, you have to take on a lot. You have to be able to stomach a lot more volatility than you do with something like like an SCHD, like a VYM. And I'm going to transition this over. Let's look at the chart, the total performance, and see how all of these compare, because I hold Devo. Devo is the only one on this list that I actively hold. But yeah, we have SCHD, VYM, FDVV, Devo, VIG, and SPHD. The smallest being SPHD at 3.41 billion, which is absolutely insane. But I mean, it's interesting. 1 year, yeah, SCHD is up, but look at that. It's only up in the last couple of months. It was completely lackluster before that. VYM's a little more consistent. The rest are all a little more consistent. There is one that's down there with SCHD, and that is SPHD. But you start zooming out a little bit more, and you start to see why people do enjoy these funds so much. I mean, on the 3 year, SCHD is up 40%. You have to factor in this is including dividends being reinvested.
Invested. Yep.
Yeah.
I just think, personal opinion. This is just my personal opinion, not investment advice. I don't think people look at the Sharpe ratios, and you can go back test this at
Hmm.
Portfolio Visualizer. I mean, I came up with a couple names and said, you got like OEF, and OEF had like a Sharpe ratio of like 2.2. Well, at a Sharpe ratio of 2.2, that's something you should leverage,
Hmm.
right? So, and there's new income funds coming out on this stuff. So this, I want to say, one episode that we are going to do is what is ETF slop and what is not.
Yep. And I'm looking forward to that one. Unfortunately, there's a lot of content we could make on ETF slop.
Yeah. Yeah. And I just think,
A
I think,
lot.
I think dividend investing and the dividend funds that you brought up, that is not ETF slop.
Hmm.
Is it right for me? No. Is it right for Spencer? Maybe. Is it right for somebody else? Hey, everybody's risk tolerance is different.
Hmm. And you got to know. You have to know your risk tolerance and know your end goal when it comes to investing, as we say on the channel over and over and over again.
That's right. Yeah, because just because I do it one way and you know, oh, well, go buy some Solana today, right? You just sit back and go, it's not for everybody. And by the way, my Solana, I mean, I, just- I roll I roll my eyes when I talk about that. It's like SOLM, see 36%. But I just sit back on, yeah, I think it's like $800.
Yep.
It's not like how do I say this? It's not like I don't care,
Hmm.
but I know eventually one day it'll go back up to my cost basis.
Yep.
Whatever. Like,
Yep.
and in between time, I'll collect the 36%.
There you go.
Yeah. So
Yeah. That's awesome. And we're right at that 30-minute mark, Brad. Do you have any closing thoughts for the audience?
I want to talk about ETF slop. Put it down in the comment below. ETF slop. Next
ETF
video.
swap. Next video. We're looking forward to it, and we hope you guys are too. As always, again, don't forget to like and subscribe, and we'll see you in the next one.